Well, Nick, here it is. We're going to talk about private equity in the pest control space.
Nice. I think this is a topic that a lot of folks are interested in the industry, and they hear this term private equity, but they might not always know what these component parts and what private equity really means.
Well, that's what we're going to talk about. I think in today's session, we're going to actually do an intro to private equity. And private equity is no stranger to the pest control industry. I mean, private equity has been active in this industry for decades. And some would argue, in fact, Rollins does argue that Rollins Broadcasting acquisition of Orkin Exterminating back in 1964 was the first LBO, or first leveraged buyout in the United States. Now, that's a debatable point, but I do think it provides some great fodder for today's discussion. But before we get into that, let's actually define what private equity is.
Yeah, I think it's this term that's out there that gets bandied around a bit, but some folks might really not know what that structure is and what it means. I mean, the way I think about it in general, it's one of many investment options that someone who is allocating capital or investing has to choose among, right? So, if we were to go through those options, like if you're a large institution, or even if you're a wealth management firm at this point, you have options to invest in public equity, which would be, just publicly listed stocks that trade every day. You could invest in bonds. You could invest in venture capital, which is really early stage private investments, or you could invest in commodities and a variety of other different vehicles, private equity being one of those options.
And so private equity is effectively the act of investing in equity in a business that's not publicly traded. And it's done through a pool of capital in a fund. So let's talk about private equity fund formation. How does that work?
Yeah, so look, the way I think about private equity is a group of people first, right? So you have some folks, typically they've come from other private equity firms, or typically they come from investment banking careers where, in investment banking, you're an investment banker and you've worked at many large investment banking firms.
And then private equity. Started banking and then went to private equity, yes.
Yeah. And so you essentially, like you and some of your buddies back from Credit Suisse could have said, you know what, we're going to go out and we're going to raise money from institutions to essentially invest in private businesses or the equity of those private businesses. And so what you would have done is you would have gotten together, put together a nice presentation deck, which private equity folks are known to do, and you would have gone and tried to raise money from people. Okay. And so when you were out there raising money, you would go to a large endowment, like a large pension fund, various institutions. It could be, a university endowment, a teacher's pension fund of a large state, something of that nature. And those folks are saying, you know what, we believe in the investment acumen of this collection of individuals, and we're going to allocate them some money or invest some money in them so they can go execute this strategy of investing in equity in private businesses. Okay. And that's essentially, in my opinion, the genesis of what a private equity fund and private equity investment advisor is. What do you think about that?
No, I think that's exactly right. And I think had I done that, which I did not, but if me and some of my old banking buddies would have gotten together, we would have set up what's a very typical fund structure in the United States. We would have said, okay, this is a limited duration, closed-end limited partnership, and it would last for 10 years. And we would have gone out with our pitch deck, and we would have attempted to explain to investors how we're different, how we can find companies on the cheap, how we can buy companies on the cheap, how we can do all sorts of things. And of course, we're not doing this for our health. We need to make money. So if we set up a private equity fund, we would have been the general partner, and we would have gone out to find limited partners. And we would have established the fund and said, look, here's how we're going to get paid. We're going to take approximately 2% per annum from the fund for managing. So basically that keeps the lights on in the office. It allows us to go out and source deals. It allows us to hire folks, pays directors' fees, so on and so forth, to get the fund going. And we would have gone out and thought about what sort of industries we want to be involved in, and gone out and tried to find proprietary deals. So transactions that are not marketed by firms like Potomac, investment bankers, because we know that those deals tend to be far more expensive. Now, we wouldn't be able to avoid that in its entirety, but our focus would have been exactly what goes on today in the pest control market. Sending out, private equity firms sending out emails, for example, to sellers and taking them to ball games and taking them to dinner and trying to wine and dine them. And we'll talk about that in a later section of this discussion. But we would have taken.
Can I ask you really quick? Could you back up on one point? So these private equity firms that set up these partnership entities that they manage as the general partner, are you typically seeing, Paul, like those particular funds or those partnerships target just pest control? Or are they also investing in technology firms? Are they investing in other residential services? I'm just curious what you're typically seeing, because I think it'd be important for the audience to understand that.
Yeah, I mean, way back in the day when I worked for American Capital, and at the time it was the largest publicly traded buyout shop in the United States. American Capital went public, I think, in 97. Wow. I worked for American Capital in the early 2000s, and basically, just like KKR is today, that was a publicly traded firm that raised money in the capital markets and went out and made investments in the private markets. And those come in all shapes and sizes. And I think as private equity continues to proliferate, you get more specialization. Back in the day, in the 80s, 90s, you had buyout shops, and what they would do is they were relatively industry agnostic. You always had kind of the tech investors versus everyone else, but for the most part, they were industry agnostic generalists. They would attempt to go out and use the smallest amount of equity as possible, so the smallest amount of cash from their fund, and take on as much debt as possible to go out and buy a business. And returns back then were largely financial engineering, right? That was the old school way of doing it. Put a bunch of leverage on a business, trying to make some improvements and flip it in the future.
Except you could actually buy them pretty cheap back then.
You could buy it phenomenally cheap compared to today. Absolutely. Yeah. But to your point, now you have funds that tend to specialize. A lot of bigger players out there will have, large funds. They'll have middle market funds that focus on middle market businesses, and they'll have their small cap funds that'll focus on, it's usually the smaller funds that are focused on pest control, because at the end of the day, pest control is a small industry. We look at it and say, wow, it's a $20 billion industry, but that's actually very tiny compared to a lot of other industries on the planet. So those funds will typically invest in things like pest control. During COVID, we saw the proliferation of home services investing, right? So we see them looking at things from across the home resi services spectrum, from pest to guttering to roofing to plumbing, HVAC, the whole 9 yards. But you tend to have funds that will specialize in allied industries. And they do that because, number one, they can build up a lot of relationships in industries, as opposed, when you're agnostic and you're trying to boil the ocean, it's really hard to meet a lot of people in one industry, right? You can't go to every conference on the planet. So they can go to Pest World.
Especially when you're trying to get proprietary deal flow.
Exactly right.
It's key for them.
Exactly right. So they will specialize. They also tend to specialize in where they want to be on the capital structure. And we'll talk about this very heavily in the structuring of the deal section of our discussion. But in very basic terms right now, some funds want to be control investors, meaning they want to own, the majority of the equity of a target that they buy. And some want to be minority investors or growth equity investors. And again, we're going to talk about that. But I would say in pest control, the majority of private equity investors are on the small and lower middle market. They're focused on controlling stakes as opposed to minority interests in pest control businesses. And they tend to focus on narrow industry subsegments, meaning they might just focus on business services or consumer services, and some might even get more granular in home services or commercial services and so on and so forth. So yes, to your point, we are seeing specialized funds.
And so then, I think it would be helpful to really understand, once they've raised the money from institutions or, wealth management firms, for instance, then like, what do they do?
Yeah.
Right. I mean, we all know they're out there trying to buy businesses, but what does that actually look like in practice? And once they bought their first pest control business, then what?
Yeah, I mean, that's a great question. You also, you always want to keep incentives in mind. So back to your original example of had I gone out and raised a private equity fund, I would get paid in one of two ways. I would get my management fee, which is not really the way anyone wants to make money in private equity. It just keeps the lights on effectively. Really where the big bang for the buck is the carried interest. And so in a typical fund, what does that look like?
What is carried interest? What does that even mean?
So let's talk about what that is. That is, in very basic terms, that is the GP, or the general partner, or the private equity firm, the guys who are managing this is their split of the profit. So when you go out and raise money, limited partners put $1 billion into this fund. Now, me as the private equity guy, I got to go out and find businesses. I got to buy businesses. I got to improve businesses, and then I've ultimately got to sell them for more money than I bought them from. But if I'm able to, more money than I bought them for. But if I'm able to do that, there's capital appreciation. I buy a business for $100 million. I sell it for $200 million. I've made $100 million in capital appreciation. Now, the carried interest is my split of that. What's my piece of the action as the private equity guy? And typically, in the private equity industry, we're on a 2 and 20 model, right? 2% management fee, 20% of the upside. And usually in the United States, there's some sort of a minimum hurdle, meaning your LPs, the investors in the fund, have to get a minimum return before the general partner or the private equity firm can start to take their 20% of the upside.
Yes.
But that's how the economic model in private equity works. And I think one of the things that's very complicated, and I think what we'll probably see, Nick, in coming years is that a lot of sellers out there that sell to private equity firms do not understand what the hurdle rate looks like. They don't understand what management fees are. And more importantly, they don't understand how private equity firms put their investments in capital structure. And what I mean by that is if a private equity owns preferred equity when they buy your business and you've rolled into common equity, that preferred equity might actually have a required rate of return. So the private equity firm gets paid before you do, the seller. And there might also be a liquidating preference on that in case something goes awry and they have to sell, the private equity firm gets paid out first. So these are important things that you need to think about. And we're going to talk about that in a section about the risks and benefits of partnering with a private equity firm. But
man, I think that's extremely valuable information, and that's going to be great for potential sellers because, man, I've seen plenty of pest control sellers that go into private equity deals and they really haven't seen the breadth of the options that are available in terms of, ownership structure and shareholder structure, as you mentioned, pref versus common, for instance.
Exactly right. And, I think the basics that people need to keep in mind when you think about this is a private equity fund is an amalgamator of capital, and it's investing it in privately held businesses. If you own a pest control business and you're going to, quote unquote, partner with a private equity firm, typically what you're doing is selling a substantial portion of your business. You might be selling 80% of it or 70% or 90%. You're rolling equity, so you're remaining a partner. We'll have a whole section on equity roll, but you're going to be remaining a partner with that private equity firm going forward. And you're either going to be a platform investment or you're going to be an add-on investment. And
what does a platform investment mean for folks?
Yeah, a platform investment, if we think about private equity, and we think about what's gone on in pest control in recent years, we've had a variety of firms get into the space. So Thompson Street Capital Partners, through its Pestco platform, is probably one of the bigger ones now. Outside of EQT and anticimex, which is effectively a publicly traded company at this point. It's so large. But Thompson Street Capital Partners came in and bought Ken Fox's business in September of 21. That was their entry acquisition into pest control, and he was a platform acquisition. And Ken Fox was a Potomac client. We've had him on Potomac TV. He's a dynamite individual. But that's how Thompson Street entered the pest control space. They bought him as a platform acquisition. And from there, they went on and made a series of about 15 other acquisitions. We've had a lot of their other sellers on Potomac TV, the Borg brothers, Jared and Jacob Borg. The list goes on. I can't think of all of them right now. But so a platform acquisition is kind of the first acquisition in the pest control space. Levine Lichtman bought Select Exterminating. That's a business that we sold up in New England, or not New England, in New York, just last year. Select is Levine's platform. Matthew Garton is running Select. He's the son of the former owner, and Matthew now is the CEO of Select, and they're attempting to make add-on acquisitions. So Select is the brand, that's the platform. Select will make acquisitions underneath that. And typically those acquisitions can either be ones in which the seller rolls equity, Nick, or the seller might do 100% change of control. When you're an add-on acquisition or a bolt-on to a private equity platform, a lot of times you'll have the opportunity to decide whether or not you want to get out 100% or you want to roll equity and partner. And when you don't roll equity, when you sell 100% of your business, it's very similar to doing a deal with Rollins or Rentokil or anticimex in those particular cases.
That's interesting. Yeah. Have you seen any pest control acquisitions that, weren't geared towards continuing to acquire other companies?
No, because
so like a pest control or private equity company enters and they just go big right out of the gate and then just continue to try to grow that organically. I think it could be important context for folks to understand.
Well, I think that I think we're likely to see that, and I think if I think back to U.S. private equity history with regard to pest control, like anticimex is an interesting case study. Anticimex entered in the summer of 2016. They bought a small, like $5 or $6 million business in New Jersey, and I had met Anticimex. I was living in Switzerland. I did deals with them overseas in Europe and Asia for years prior to that. I'm getting in the United States. And they were always looking, hey, we want to get into the US, but transaction valuations were way too high. They just didn't want to spend the money because the rest of the world was a lot cheaper. Finally, in 2016, they entered. And what they did subsequent to that is in 2016, 17, 18, 19, they went all up and down the East Coast. They bought J.P. McHale's business. They bought the Stevenson Brothers Modern. They bought Killingsworth. They bought American. They bought Tony Sfredo's business. So they had all these platforms, and all of those platforms were doing their own subsequent add-on acquisitions. And they had to pay a lot of money for those businesses. And the whole theory is you pay to play to get the platform, but then you blend down your multiple as you do add-on acquisitions that become a very, very accretive. To your question, I do think it is likely that we will see a private equity firm within the next 12 months enter pest control and not think about doing acquisitions, but buy a high growth business and really focus on the organic aspects of it. I think that that's a possibility, but I think that's more a minority or growth equity investment than funds that are focused on control positions in businesses. I think a minority investor would be more likely to focus on organic growth than somebody coming in from a control perspective trying to blend down their multiple.
Why is that? Why do you think they would do it that way as a minority?
Because I think that those would be growth equity investors, and I think that they would buy businesses that not only are doing door to door, but can demonstrate the ability to grow rapidly grow rapidly organically. Pest control is an industry that grows inch by inch. It is very hard to get high rates of organic growth year over year. But there are some companies that are able to do it. And so those are likely the companies that minority or growth equity investors would invest in, as opposed to a traditional buyout shop. Because if you think about it from a value enhancement perspective, these are roll-ups, right? These are classic roll-ups. And what I mean by a roll-up is you go out into an industry, you find 50 small companies, you buy them and effectively jam them together. You get cost savings, you get revenue enhancements from cross-selling, you're able to upgrade management, and then the private equity fund can bring in a lot of its capabilities and resources and really tool the business up. And so,
and like a key point within that is that the reason a roll-up works financially as well is because the idea is that you're buying these smaller businesses at lower valuation multiples than the whole is going to trade at once you put it together. So you're buying it, 10 times, or pick a number, 8 times EBITDA, 5 times EBITDA, 10 times EBITDA, and then all of a sudden you have this bigger organization that trades at what they hope might be 15 times EBITDA. Right. And so by continuing to roll those up at lower valuations and then have the larger entity traded at larger valuation, that's what makes the financial engineering work, in addition to all of the improvements that you mentioned.
No, that's exactly right, Nick. If I think back to 2021 when anticimex was trying to go public. So anticimex engaged Citi and a variety of other investment banks to take the business public. They went on the typical investor roadshow. So
what year was this, Paul? What year was it again?
This was in 21.
21. Open capital markets too. Yeah. Okay.
It was a great time. They hired investment banks. They went out and did the road shows. And one of the a large Danish institutional investor hired me to basically take a look at anticimex. They were going to put a substantial portion into the IPO. They owned already a significant portion of anticimex through its current capital structure, and they were going to really double down on this business.
I'm curious because I think it might tell us something about the structural nature of how investors allocate to private equity versus public equity. Could you elaborate on this Danish investor's intent and the history around it?
Yeah, so I don't want to give too much information, but they were an investor in EQT, or they continue to be an investor in EQT, which is one of the largest asset managers, one of the largest private equity funds on the planet. I think they might be top 10 from an assets under management perspective.
Yeah.
And they, along with GIC and a few other firms, own anticimex. And so this Danish fund was an investor in a variety of EQT's funds. EQT, as we talked about earlier, EQT is a big fund manager, but they have funds that one focuses on infrastructure, one's on middle market, one's on tech, one's on big LBO. They got a bunch of different funds. So yes, they are an investor in EQT, and they were considering doubling down on anticimex during the IPO process.
That's interesting. It's an interesting example of how an institutional investor could invest in not only private equity as an option, but then public equity.
To your point,
as they see that opportunity.
Exactly right. So they owned it as an LP in a private equity fund, but they were seeing it as coming public and the opportunity to actually directly own that equity on the publicly traded equity market. So yes, as we discussed earlier in the discussion. But when anticimex was in the United States, I think we were on the sell side on the majority of the platforms acquisitions that anticimex made from 2017, 18, 19, 20. When I think about McHale and Modern and Killingsworth and Triple S and Innovative and all these different Clarks down in South Carolina. Anticimex would go out and on transactions that were competitive processes. They were paying somewhere between 13 and 20 times EBITDA to buy these businesses. So that's what they were very expensive. But they were able to go out and buy some platform acquisitions that were not competitive processes at lower multiples. So sometimes they were getting these for 10 times or 11 times EBITDA. And then in those days, they were able to go out and do add-on acquisitions at sub 10x, meaning let's say I've got to buy one business for 15 times EBITDA. Then I can go out and buy a bunch of add-on acquisitions and I can get them 8 or 9 times EBITDA, right? And so I'm blending down my multiple. Now I'm anticimex and I want to go public. Anticimex didn't end up going public. They recapped that business. and brought in other private equity investors. The reason why they didn't do that is they wanted north of 25. They wanted to float that thing at north of 25 times EBITDA. They really were targeting 30x, right? And the market just didn't support that. And so I actually think anticimex made an error in pulling that deal when they did. They actually pulled it from the market and said, we're not going to sell now. We're not going to go public because we're not getting what we believe that we should. And then you saw what happened at the end of 2021, and the markets really rolled over by 2022. But that's not the point of my discussion. The point of my discussion is they, at the end of the day, could have gone public in the low 20s, right? They could have floated that thing at 20, 21, 22, 23 times EBITDA. And but they were buying these businesses for 15 times, 12 times, and they bought a ton of them for 7 or 8 times EBITDA. So you can just see the arbitrage there, where you're able to go out in the private markets, buy these things cheaper, and then ultimately sell them into the public markets at a much higher multiple, which is the great hope of many private equity firms, which is buy a bunch of stuff on the cheap, turn around, package it, and float it publicly, and get that arbitrage.
Yeah. You can even see that outside. This conversation is about private equity, but you even see that outside of private equity with just larger pest control operators trying to buy businesses cheaply.
Absolutely.
And then rolling it into their own organization.
Absolutely, you do. Nick, I think this has been a great part 1 to this series. As we move this forward, in part 2, we're going to talk a lot about the investment process. So how do private equity firms size up acquisition candidates? What do they think about from a valuation perspective? How do they actually do the deal, so on and so forth. And then I want to move into part 3, where we're going to talk about the benefits and the risks in partnering with private equity. There's a tremendous amount of benefits if you're a potential seller out there and you're looking at rentokil and orkin and a variety of different acquirers, and you've got all these private equity firms. There's a ton of benefits, but there's also a lot of risks. And I think folks a lot of times will focus on the benefits and not so much think about the risks. So I want to zero in on those. In part 4, I'd love to discuss how the deal is structured. What is equity role? How does that work? How are these transactions structured from membership participation agreements? What do they require from the owner and their team, so on and so forth? And ultimately, how do private equity firms structure these deals with the end in mind? Which takes me to part 5, where I want to talk about performance optimization and value creation. How do these private equity firms actually, it's one thing to go out and just buy for X and sell for X plus 5, but how do they actually create value? And then in part 6, I want to talk about returns, expectations, and commitments with regard to partnering with private equity firm. And my main question, if I were a potential seller, is how do I get my money? What do you expect of me? Do I have to stick around? Do I have to perform? And then if I've rolled equity, are these guys going to go public? Are they going to sell it to another firm? What if they don't do any of that? Do I lose my rolled equity?
Yeah, you're telling me I'm going to get 2 to 5 times my money on my rolled equity. And so how does that actually happen from an operational mechanistic standpoint?
Oh, and we will talk about that.
That'll be helpful.